Good evening, students. Is my voice audible to you guys? Please confirm, then we will start.
Yes, sir.
Thank you. Thank you. So, in the last session of the financial reporting, we are at the third chapter. That is, we actually see the different financial in Indian accounting standard that we understands in this chapter, the third chapter of the subject of financial reporting. Okay, actually, we in the last sessions we see the AS7, that is the statement of cash flow. Okay, in that we see how cash flow must be prepared by the uh, companies. Okay, so in that we see the cash flows, the cash flow must be divided into the three types of activities. That is the operating activities, investing activities, and then financing activities. So in that we see which are the different cash that we can see inflows and outflows, which we included in the operating activities. We actually see the we can say for the main business for the main operations of the organizations. What are the cash flows? That is the cash inflows and outflows. That is whenever the company is generating the revenue by selling the goods of the company, or if the company we can say it is a service company, then by selling the service of the company, whatever the cash inflows the companies recognize. Okay, and mm, for we can say the production of the goods and service. Okay, we know for the production purpose there are the different expenditure or the expenses the company must have. Okay, so all these cash inflows and outflows we included in the operating activities. So same likewise in financing activities and in investing activities, we actually whenever the companies invest any amount of money in the hope of return. That part we included in the investing activities. In financing activities, whenever the company wants the funds to, we can say, for the expansion of the business, to requirement to fulfill the funds requirement, whenever the company we can say raise the finance, that part we included in the financing activities. That means we can say the changes in equity whenever the company raise the loans through the bonds, debentures, and the issues debentures. So all these we included in the financing activities. Okay, Indian accounting standard 1 and Indian accounting standard 7, that we understand in the last two sessions. So in these sessions we are going to understand what is mean by the AS8? That is the just a second. I'll share the PPT with you so you can understand it very. So in Indian Accounting Standard 8, the accounting policies changes in accounting estimates and errors. Okay. So in the standard, whenever we say if the company wants to revise the financial statements. Okay, so in that conditions, what are guidelines the company must follow, that we are going to understand uh, that part in this accounting standard. That means the guideline for to we can say remove the errors Okay, if any change company wants to do in their financial statements, so for this purpose, the AS8, the Indian Accounting Standard 8, that provides the guidelines. Okay. So in this chapter, we are going to understand the AS8 and AS34. So AS8 is about, we can say, the accounting policy changes and errors, and AS34 is about the interim reporting. Okay, whenever that means the ASA tells about the, we can say, the changes in accounting estimates and errors. If the errors company made in any financial statements, now they want to, we can say, correct that error. So for this purpose, the AS8 provides the guidelines. And whenever the company wants to publish their financial information in between the financial years, we know that the every company, every organizations prepare their financial statements at the end of the financial year. Okay, but because of some, we can say, some of the major decisions, same like if the any company acquire the another company, whenever the two companies are doing a merger. Okay, whenever we can say a huge any company, any group, we can say the big corporate houses like Reliance, Tata, when they start the new business, okay, the group start new business when they launch the new product. So these are the, we can say, some of the major decisions. Okay, so that this major decision must be known to the shareholders. Okay, that information must be known to the real owners of the organization. That means, as we know, the Tata or the Reliance. So these are the very big corporate houses, but they are listed in the share market. That means their some of their ownerships they made public. That means if I have the share of the Reliance, that means whatever the decisions taken in the Reliance organizations, that must be known to me, because I have invest my hard-earned money into that organizations. Okay, so whenever such a major decisions are taken in the organizations, at we can say, the company provides the, uh, we can say, the interim company, we can say, uh, prepare the interim financial statements. Okay, yeah, they do the interim financial reporting. So okay, so that in AS8 we understand the, we can say, changes and the error corrections, and in AS34 we are going to understand the interim reporting. Okay, what are the different guidelines provided by the accounting standard 34 for the, we can say, in between any financial year, whenever the company wants to provide the their financial informations to the different stakeholders, to the shareholders, to the investors. Okay, so that part we are going to understand in these sessions. Okay, so let's see what is AS8. Okay, so AS8, we can say it, Indian Accounting Standard 8 establishes the comprehensive framework for managing the accounting policies, changes in estimates and error corrections. Okay, so whenever, we can say, whenever there is the any change in policy, any change in accounting policy, we can say any change in estimates. Okay, if the company, we can say, wrongly placed any value in their financial statements, but now the company realize that the information they put in the financial statements, they are wrongly placed. Okay, sometimes it happened because we know that the sum of, if the sum of the financial transactions while entering into the books, okay, while we can say, while the preparation of the ledgers, if the some of the entries were missed, so at that point of time, what happened, we can say, the accurate financial statements not prepared. Okay, so at that point of time, we can say, any change in estimates who wants to do by the company, so they need to follow some of the standard guidelines. So these guidelines provided by the Indian Accounting Standard 8. Okay, if sometimes if the any errors made by the company while the preparation of the financial statements, so they can correct that errors. Okay, so how they correct that error? So the, for that purpose, the guidelines provided in the Indian Accounting Standard 8. Okay, so what are these guidelines that actually we are going to understand? Uh, okay, so uh, we'll see that is we deeply understand what is the Indian Accounting Standard 8. Okay, so the accounting policies represent the specific principle basis the convertible rules and particles that an entity adopt when the preparing we can say in presentation is financial information. What is meant by accounting policies? So accounting policies is we can say these are the policies they we can say provide the specific rules, specific principles, we can say the base, okay, convention, rules and practices, how they present the we can say their accounting or the financial information. So these policies form the foundation for how transactions and events are recorded. That means how the different we can see the fund inflows and outflows entries were recorded in the we can see in the bookkeeping or in the while the preparation of the ledgers. So all these the accounting policy provides the, but if there is any change in the rules done by we can say the by the authority, then we can say then the in Indian Accounting Standard 8 we made the changes, and accordingly we further we can say apply these uh, policies. Okay, so these accounting policies, we can say, provide the guidelines to when to recognize the transactions, how to value the assets and liabilities, and how to display the financial informations. Okay, so selecting and applying the accounting policies, how we select we can say the accounting policies while preparation in the preparation of the financial statements. Okay, actually we do that apply the relevant Indian accounting standard. Okay, so when we are preparing the financial statements, okay, we read thoroughly all the accounting standards, that is from Indian Accounting Standard 1, 2, okay, 8, 34. So all these we first read and then we apply while the preparation of the financial statements. Okay, when a specific Indian accounting standard exists, okay, that accounting standard must be followed. Okay, when no specific standard exists, develop the policies using the professional judgment and the best practices. Okay, uh, so all these are the policies provide the clear guidelines in the preparation of the financial statements. Okay, so when there is the we can say the changes in the accounting policies where we see, okay, when allowed, okay, when the companies can we can say uh, use the we can say the change accounting policies when the authority approved that change in the accounting policies. Okay, when allowed. Okay, when only when the required by the Indian accounting standard, or when the change result is more reliable and the reliant we can say the relevant informations, then and then only we use the change policies. We can say that if the we can say the application method, when there is we can say the application method itself is changed, then we use that change application method that must be applied retrospectively unless the impracticable to determine the effects. Okay, third one is the disclosure requirement. Okay, whenever if the requirement of the financial statements to disclose that informations or to use that certain method, then for to fulfill the requirement, okay, at that point of time we use that change here is the one example of we can say the change in the accounting policies, that the one scenario is given in the manufacturing company, that a manufacturing company decides to change its depreciation method from we can say the straight line to the double declining balance for its production equipment. We know that there are the different depreciation method is available by using the different methods. We calculate the depreciation of the machineries we used in the production of the different goods. Okay, so how the value degrades over a period of time. We know that. when we use the machineries for over a period of time, automatically its value degrades, okay, decreases. So that's what we called as the depreciations. Okay, so first the company uses this straight line method. That means every year they thought that the same value gets decreases, but it is a one type of method, and the next one is the double declining method. That means first year, if let's take the example, if I say the value of the machinery is 10 lakh, then the company thought that every year the value of the company decreases by the 1 lakh. So this is we can say the straight line method. Okay, so in first year the value of the machinery decreases by 1 lakh. In second year also 1 lakh, third year 1 lakh, fourth year 1 lakh. But it is not in case of, we can say, the next type of method, that is the double declining method. That means first year the value of the machinery decreases by 1 lakh. In second year the value of the machinery decreases by 2 lakh. Okay, so this is how, this is the double declining method. Okay, so these are the different types of depreciation methods. By using these methods, we can calculate the degrades value of the whenever the initially the company we can say calculate their depreciation by using the straight line method, but now they want to calculate it by the double declining methods. Okay, so they by using the AS8, now they can change their entries into the financial statements. Okay, so we can say the disclosure, what the better reflects the actual use pattern and the economic benefits. Okay, what is the financial impact of that? Whenever we change from the one accounting policies to another accounting policies, higher depreciation expense in early years, lower its later years. Okay. Next one is the must explain the reasoning and quantify effects on the current and the prior period. Okay. So changes in the accounting estimates, that is what are the we can say the changes we found in the accounting estimates. So first change is the new information. First, we can say if initially the sum of the uh, information is not available. Okay, sometimes it happens, but what we realize that the new information is now available, so we can add that informations in our financial statements. So at that time we can add the additional data becomes available, so we can add that additional data. Now analysis and evaluation assess the impact of the existing estimates. Okay, so this we can see the additional information now available. That information, what the informations, we can say how the information have an impact on the existing estimates that we know. Next one, we can see the prospective application, apply the change to current and the future periods. Next one is the estimate adjustment, revise the estimates based upon the new insights. So whatever the new informations, the new insights is available with the organizations, by using that we made the changes and we estimate the, first we can say we make the adjustment, and we after that we we can say we can say revise the estimate, and based upon the new insights we calculate the what is the impact of that. Okay, so here is one key example is given. Revising the useful life for machinery from 10 to 8 year based upon the actual usage pattern affecting the future depreciation calculations. Okay, so we change the one method to another method. That is from we can say this straight line depreciation method to the double declining methods. Okay, sometimes what happen, so this is the change in accounting policy. Sometimes while the preparation of the financial statements, the accountant or the financial expert who we can say made the mistakes in the financial statements. So some of the how the errors, what are the different types of errors? First one, we can say the mathematical mistakes. So we know that we are human. Okay, so human may make a mistakes. If the person, the accountant or the financial manager who prepared the financial statements, okay, might be at some point of time he made the human error. Okay, he can, we can say he made the mistakes in calculations, in addition, in subtractions, in multiplications. So these are the mathematical mistakes. So such a type of mistakes may happen in the financial statements. So next mistakes is, we can see the misapplication of policies. Sometimes the some of the accounting policies may be misapplied at the wrong places. So that may happen. Sometimes we can say the oversights or the fraud. Some of the accountants who intendedly made the mistakes, okay, because whatever the reason, but they made the fraud. Now next one is the misinterpretations of fact. Okay, some of the times that the company put the wrong information in their financial statements to manipulate the different stakeholders, okay, to attract the investors. So we can say these are the sometimes type of errors. Okay, so uh, what are the material errors that require the retrospective restatement of the prior period financial statements with the appropriate disclosures? Okay, so whenever we rectify that errors, whenever we can say correct that errors, so at that point of time we need to, we can say, require the retrospective restatements. Okay, that means we have to revise the statement, and we have to make the appropriated disclosures, actual or the realistic disclosures now. Okay, so these are the, we can say, how the correction errors we rectify. Now next one is, we can say, the some of the examples of the corrections of the errors is the omitted revenue corrections. Okay, so identify errors, determine the omitted revenue amount and period. Okay, sometimes what happened, the company, this is one example, that is the revenue company recognize, that is, they get the revenue, but they omitted from the financial statements, okay, to show the less profit to the organization, so that the shareholders don't ask for the dividends. Okay, so sometimes the company do like this. So at that point of time, now company needs to correct the financial statements if the we can say the regulatory, some of the regulatory body finds that the financial statement is incorrect. Okay, so during the current year audit, or the company discovers that the revenue from the major contracts completed in the previous year was never recorded in the books. Okay, sometimes may happen they miss any entry of the revenue. So it is not always the case that company is doing the, we can say, they put the misinformations, we can say, they intentionally, but sometimes they can miss the A entry. Okay, so disclosure requirement under the AS8. Okay, so what are the, we can say, different disclosure require when that the must, these are the must to do things under the AS8. So what are that requirements? First one is the nature reason. Okay, so whenever we can say we rectify the errors, okay, we change the accounting policies, at that point of time the detailed explanation of changes in the accounting policies or estimates, including in a business rationale. Okay, so whenever we do that change, the detailed explanation must be there in the financial statements. Okay, without that explanation, that we can say that change the rectification of the errors, we can say the change in the accounting policy, or that will not be we can say the accepted in. Okay, so that detailed explanation must be there. Then next one is the company needs to assess the financial impact. Okay, whenever they use the AS8, okay, and they made some changes. So the quantitative analysis showing the effect of on current and prior period financial statements. Okay, due to that change, what that how that change impact on the on the current and the previous period financial statements. Okay, so that impact must be assessed by the companies. Next one is, we can say, the error corrections. So complete whenever we correct, we rectify any error in the financial statements. So the complete disclosure of prior period errors and their effects and the corrective actions taken. that all information should be disclosed in the financial statements. Okay. Next one is we can say the a comparable comparative information. So the adjusted comparative figures and the explanations to maintain the year over year comparability. Okay, so all the data should be we can say the properly placed in the financial statements. Okay, so these are some guidelines provided by the AS1. Okay, so here I'll show you the actual. If you see here, just a second. Yes, yes, here. Okay, so here is the Indian Accounting Standard AS8 guidelines. So if you see the guidelines are is near about the 6 to 7 pages. Okay, so all how the changes made by the what are the different we can say the guidelines here given. Okay, so first we read the objectives of AS8. The objectives of the standard is to prescribe the criteria for selecting and changing the accounting policies. Okay, so they prescribe the criteria. Okay, when you select which accounting policies, that criteria is given in this accounting standard. Okay, together with the accounting treatment and disclosure of changes in the accounting policies, changes in the accounting estimates, and corrections of errors. This standard is intended to enhance the relevance and reliability of entities' financial statements. Okay, so all the disclosures related to uh, changes in accounting policies, changes in accounting estimates, and correction of errors. So all these guidelines is given in the AS8, Indian Accounting Standard 8. Okay, so uh, uh, so this standard is intended to enhance the relevance and reliability of entities' financial statements. Okay, so when we can say the financial information provided by the company is reliable, when the information is the error-free informations. Okay, uh, and we can say so in objective, the last line is the comparability of those financial statements over a time and with the financial statements of the entities. Okay, so this is we can see the main objective of the Indian Accounting Standard 8. Okay, so what is the scope of the Indian Accounting Standard 8? The standard shall be applied in selecting and applying the accounting policies and the accounting for changes in the accounting policies, changes in the accounting estimates, and correction of prior period errors. Okay, so whenever company wants to do all these things, that is the applying the accounting policies, first they need to refer the Indian AS8. Whenever they want to change in accounting policies, they first need to refer the AS8. Whenever they want to change in accounting estimates, first they need to refer the AS8. Whenever they wants to rectify the errors, first they need to refer the AS8. Okay, so this is we can say the scope of the AS8. Okay, so the here we can if you see, so here all the detail guidelines are given. Okay, so what are the different guidelines given on the accounting policies? Okay, selection and application of the accounting policies. If you read here, so here the one at the above the point number 7, here the heading is given: accounting policies, selection and application of the accounting policies. Okay, so if you read that 7 number point, when an Indian accounting standards specifically applies to transactions, other events or conditions, accounting policy or policies applied to that item shall be determined by applying the Indian accounting standard. Okay, so in this all the we can say I'll share with you guys the link. Okay, you read it thoroughly, then you will understand okay in what situation, in what policy the companies must apply. So the all this part is given in this part. Okay, so here the if you read the heading, that is the applying in the accounting policies. Okay, so whenever the company wants to change the accounting policies, okay, so they need to refer first the all these things. Okay, so next, if you read here, that is the accounting estimates. Okay, so on accounting estimates, here some of the guidelines are given. Okay, uh, so in changes in the accounting estimates, so for this also the different guidelines are here given in the AS 8. Okay, so here if you read the heading, that is the disclosure of the prior period errors. If you the company wants to rectify the errors which they did in the we can say the previous year financial statements. So for this, the here the we can say different types of guidelines and disclosures given in the AS8. Okay, so I will share the link of this with you in the chat box. Okay, so you just copy that link. Okay, and after whenever you have time, you can read that AS8 thoroughly. So it is not possible for us to read all we can say the document fully in the uh, sessions. Okay, so it's request to you, so please read whenever you got the time. So now we understand the next is Indian accounting standard, that is the interim financial reporting. That means when we know that every company disclose their financial information at the end of each financial year. Okay, so this is we can say this is the routine work for the all the organizations, all the companies. But if the any company wants to disclose their financial information, financial statements in between the years, so that reporting we called as the interim financial reporting. Might you guys have heard the interim budget? Okay, we know that there is a one main budget which we uh, you guys see on the first fave of each year. Okay, the finance minister of India present the we can say the financial budget. Okay, but whenever the governments if the situations like in we can say some of the major events, like we can say some of the natural calamities like the earthquake, tsunami, some of the we can say the financial health crisis like the COVID-19, some of the situation like the financial crunch, financial crisis. So at in such a situations, government also come up with the interim budget. Okay, or whenever there is we can say uh, the 5 years of the government's over, then the government that means we can say the in the last year, if you guys know that the Modi government come with the interim budget because there is election in the next 2 3 months. So in such a situation, the government coming with the interim budget. We so same likewise the company when there is some of the major policy changes are happening in the organizations. Likewise, I already told you some of the examples like the mergers of the two companies, or the one company acquires the another company. If the company launches the new plant, they launches any new product. Okay, so in such a situations, the company wants to uh, disclose their financial information in between the year, so that we can say reporting we called as the interim financial reporting. Okay, so what are the objectives of the Indian accounting standard 34? Okay, so how this Indian accounting standard 34 provides the guidelines for the interim reporting. So first objective is the timely informations. So that interim financial reporting that provides the timely information to the different stakeholders. Okay, who is interested in that organizations, that is we can say from the investor to we can say their their creditors, okay, shareholders, okay, management. So all these are the different stakeholder who gets the timely information on of some of the financial parameters. This provides the stakeholders with the reliable financial information from for interim periods, enabling better decision making between the annual reports. We know that in every annual report the company, we can say, disclose their financial statements, but in between the year, now company thinks that this information is a very essential to take the decisions. Okay, so that in between the year, then company disclosed the financial statements, financial information. So next one is, we can say, objective is the consistency maintain. That is that ensure the interim financial statements are prepared using the same accounting policies as the annual statements. Okay, so interim financial reporting is, we not say that uh, the format of the interim financial statements are different from the annual financial statements. The format is same. So just the thing is that whenever there is the any major policy change, uh, the company wants to give a timely information, a quick informations to their shareholders, so that the every investor, every shareholders have the confidence in the company. Okay, so that's why they provide that interim financial reporting. uh, the standard bridges the information gap between the annual reporting periods and offering the quarterly semi-annually insights into the company's information. Those investors who invest their hard-earned money in the company, okay, so they always curious about the what is the actual position of the organizations. Okay, how the companies perform in the last 3 months, how the company perform in last 6 months. Okay, but they need to wait for the next year, okay, to get the financial statements. But if the company provides them the financial statements quarterly, 6 monthly, okay, so we can say the investor is we can say their confidence is constant in that organizations, in that company. So company is also, we can say, the readily we can say think to provide the timely financial reporting to their different investor or the stakeholders. Now, key requirements. Okay, what are the key requirement of the Indian Accounting Standard 34? Now, first one is the minimum content. So that for interim financial reporting must include the condensed balance sheet, income statement, statement of cash flow, and exploratory notes and covering the different significant event. Okay, so the AS34 also says that the companies need to prepare the same financial statements which they provides in their annual reports. Okay, that is balance sheet, income statement, and this statement of cash flows, but with the explanatory notes. Okay, so okay, so that the readers of that financial statements who get the thorough information. Next one is the policy uh, consistency. That means while the preparation of this financial reporting, okay, use the same accounting policies and measurement principle as applied in the most recent annual financial statements. That means the policy should be a constant. The format of they used in the preparation of the financial statements, that must be constant. Okay, so that consistency which mandated by the Indian Accounting Standard 34. Next one is, we can say, the event explanation. Okay, we can say why the company came up with this interim financial reporting. Okay, so in between that period, what are the major events where happen? If the companies acquire any another company, if the company, we can say, sell any of the major property, or purchase any of the major property, if the companies launch any new product, so all these events must be explained thoroughly in the financial statements that provide the details explanation of the significant event, that is some of the major events or the transactions or changes since the last annual reporting period. If the any change in the policy or if the company is doing, so all these event must be well explained in the financial statements, so that the different stakeholders can understand the we can say why what are the major changes there the company is doing in that we can say that uh, quarter year or the last from last 6 months. Okay, so the changes in the interim reporting. Okay, so here we can see the three challenges is given in the while the preparation of the interim financial statements. Okay, so what are the different challenges? First one is the income tax estimation. We know that every company is paying the income tax at the end of the year, not in between the years, because company is paying the income tax on the basis of the what is the profit they are generating in the business. Okay, so in the we can say whenever company is prepare the financial statements for the 3 months, for the 6 months, it is we can say it is a challenge for the accountants or the financial expert to calculate the tax. Okay, that is we can say that is the first challenge, that is calculating the accurate income tax expense for the financial periods require the sophisticated estimation techniques and consideration of the annual effective tax. So that is the one challenge. Next one is we can say the seasonal variations. Okay, so managing the impact of the seasonal business cycles and ensuring the interim results. Okay, we know that these we can say some of the seasonal variables have the impact on the businesses. Some of the changes, like we can say if the changes in the seasons, like the rainy seasons, we can say the cold seasons. So the how the seasons we can say the taste and preference of the customer changes as per the change in the seasons, so that change have the impact on the business of that of the any organizations. Okay, so to manage that impact of the season, we can see seasons on the business cycle of the organization, that is the major challenge in the preparation of the interim financial reporting. Next one is the estimate changes. Okay, handling the changes in the accounting estimates or the correction of errors discovered during the interim periods while maintaining the consistency. Okay, we can say some of the errors if you find in the if you made the errors or the we can say mistakes while the in the accounting estimations, then it's a challenge to we can say rectify that things. Okay, estimate that change, that is one of the major challenge. Okay, so what is the real world impact of the interim financial reporting? That we can say the quarterly reporting provides the 4 times more frequent financial updates than the annual reports. Okay, if the company is disclose or we can say publish only the annual reports, then these different stakeholder gets the financial information once in a year. But if the company is provides the financial information or the financial statements for the 4 times, okay, if they provides they provide they we can say they prepare the interim financial reporting for the four quarters, then the investors gets the financial information for 4 times, so he can takes the we can say the good decisions. Okay, so the 90% market confidence, that means which those companies who frequently disclose or publish their interim financial reporting, so the investors confidence in their company is increases. Okay, so we can say these studies show the regular interim reporting increases the market condition market confidence. That means the investors the different stakeholders shareholders they have they will we can say their confidence in the company increases. Okay, because they regularly receives the financial informations and the reduction of financial asymmetry. Okay, so that the informations gaps also we reduce, the companies can reduce this gap because by publishing the interim financial reports. So the 25% decision speak that we can say the investor can make the decision 25% faster. Okay, as an investor, if I get the financial information as when I want, okay, then I'll take the decisions fairly. Okay, so the investors can make the decisions 25% faster, access to the timely entering financial informations. Okay, so these are some of the real world impact of the interim financial reports. Okay, so the interim financial reporting enables the continuous performance monitoring, supporting both regulatory and compliance requirements, and enhance the stakeholder engagement throughout the financial year. Okay, so these are, so we can say, some of the uh, benefits of the uh, uh, publication of the interim financial reporting. Okay, so here I will show you the exact guidelines which provided by the Indian Accounting Standard 34. Just a second. If here you see here the heading, if you read the Indian Accounting Standard 34, so this standard provide the guidelines for the interim financial reporting. If you read the objective of the Indian Accounting Standard 34, the objective of this standard is to prescribe the minimum content of the interim financial reports and to prescribe the principle for recognition and measurement in a complete or the condensed financial statements for the interim period. Okay, and we can see the timely, reliable interim financial reporting improves the ability of the investors, ability of the creditors, and the others to understand an entity's capacity to generate the earnings, cash flows, and its financial conditions and liquidity. Okay, so interim financial statements, what they improves the ability of the investors, the ability of the creditors, and the other stakeholders to understand, to know the what is the capacity of the company to generate the earnings or the cash. Okay, they know that the company is making money or not, if the company is in profit or is in the loss. Okay, and also these stakeholders understand the we can say the real or the current financial position and their liquidity position as well, if the company is generating the profit or not. Okay, so what is the scope of to where we apply this AS34? This standard does not mandate to entitle should be required to publish the interim financial report. That means this accounting standard, that is the AS34, does not mandate the companies to publish the interim financial reports. Okay, they only provides the guideline to publish the interim financial reports. The interim financial reporting is, we can say, is the whole and soul is depend upon the wish of the company, on the wish of the management of that company or the organizations. Okay, if the management or the company wants to increase the confidence of their investor, their stakeholders, then company, we can say, they publish the interim financial reports. Okay, so how frequently that means this standard does not mandate which entities should be required to publish the interim financial reports, how frequently, how soon after the end of the interim period. However, the government, securities regulators, stock exchanges, and accounting bodies often require entities those debt or equity securities are publicly traded to publish the interim financial reports. So this standard applies if any entities require or elect to publish the interim financial reports in accordance with the Indian accounting standard. Okay, that means we can say this accounting standard does not we can say mandated to any company, any organization to publish the we can say the interim financial reporting. Sometimes the we can say sometimes the government or the we can say the stock exchanges or the different regulators, okay, who wants the current financial position or the liquidity position of the organization. So at that point of time the company themselves publish the interim financial reports. So okay, so while the preparation of the interim financial reporting, they have to we can say first read that AS 34. Okay, they have to follow that AS 34 in the preparation of their we can say the interim financial reporting. Okay, so we can say the here the if you write the minimum components of the interim financial report. Okay, what are the different no, what are the minimum that means in interim financial report, what we can say the statement mandated to publish. Okay, an interim financial report shall include the at minimum the following component. That means if the company wants to publish the interim financial reports, they have to publish the following financial statements. That is the we can say the condensed balance sheet. They have to publish the balance sheet for that period. Condensed we can say the profit and loss statement. Okay, that means the condensed income statement. Next one is the condensed statement of changes in equity. Okay, how the changes were happened in the last 3 years or so, 3 months or the 6 months, or we can say the condensed statement of the cash flows. Okay, and next one is we can say the selected explanatory notes. So all these things should be if the all these things there in the interim financial reporting, then and then only we considered it as the complete interim financial reports. Okay, next here if you see the form and contents of the interim financial statement, so what should be the forms or what are the contents required in the interim financial. So all these things are given in that AS 34. So I'll share the link with you guys. Whenever you have time, please read this AS 34. So we'll understand then thoroughly. Okay, just a second. Okay, we read that is the what are the guidelines on the other disclosures. If you see here, the periods for which the interim financial statements are required to be presented. Okay, so the guidelines on that are given in the AS 34. Okay, we can say the disclosures in annual financial statements. Okay, so all these guidelines we see in the AS 34. Okay, if you anyone have any questions, you can ask here. We have 3 minutes to go. If no one have any questions, so guys, you can leave the sessions and you will then join the sessions at the 8 p.m. Okay, so in that 8 p.m. sessions, uh, that is of the international finance. Okay, so now this session is we can say we